Welcome to Beer Stories for Private Equity. Join us for our weekly happy hour, tapping into 27 years of PE experience, one pint at a time. Beer Stories for Private Equity is powered by Monogram Group.
On today's show, we're excited to be joined by Reed Van Gorden, Head of Origination and Investment Committee member at Deerpath Capital Management.
And for Monogram Group, here's your host, Scott Markman.
Please fasten your seatbelts.
Welcome to the podcast. This is a special edition in the sense that it's impromptu. And Reed and I were exchanging emails 24 hours ago, and we were talking about a second appearance on the podcast with Reed, and because he was one of our first guests. And it sort of went back and forth. And it was, given the timeliness of what's going on in the economy this week and into the near-term future, we decided to kind of just do this. And it's exciting because it's an angle to doing a podcast that I haven't really explored before, which is to seize the moment and to bring a guest on that has got the credibility and the detailed knowledge to really frame out an interesting conversation. So, Reed, welcome back to the podcast.
Yeah, appreciate it.
In the interest of full disclosure, we have not prepared show notes, which we always do 100%. And so our conversations are typically somewhat structured. The questions, the broad topics are laid out and approved in advance. Here, we're not doing that. We're kind of flying without a safety net. So I would just say to Reed, I candidly want to avoid over political stuff. That's not really the agenda here. The agenda is really to talk about the impact on what's happening real time on private equity and getting that perspective from, kind of an insider. I certainly read what everybody else reads, and, I'm trying to understand the impact on the category and candidly our agency because we spend so much time with private equity firms and the companies they own. So I'm going to a little bit ask Reed to start this dialogue, and I'll try and sort of reflect and further the conversation as best I can. But, we're just going to wing this and see what comes out of it, and hopefully it's of interest to our listeners. So, Reed?
Yeah, so
start.
And maybe just quickly as kind of 2 seconds of kind of color, I started the week out at Deal Max, which is kind of the big private equity get-together out in Vegas. And I always say I go to that to kind of get a pulse of the market, meet some potential new contacts. And I guess this year I got a pulse on the market, but I got no answers, which I think is what you'll hear today, that there's a lot of questions, still answers. I guess to kind of set the stage, we had multiple 2, 3, 4 sigma standard deviation moves in the market this week. And one, I would say that's probably somewhat unprecedented, but two, it's definitely not, someone put it well, that the market and the economy is not a normal distribution. You have very large tails and fat tails. And I think what I pay attention most in the market is what is it trying to tell you with all this data? And the short answer is I'm not sure anyone really knows. And that being said, I think private equity is hard because it spans so many different areas. I think the good thing about private equity in this scenario is they have the resources, both the people and the money, from a capital perspective to fund projects if they need it, to fund earnings and fund cash flow if they need it, and a network, whether yourself, Scott, or all these kind of accounting firms to help on the accounting side, kind of whatever they may need to go use, that a lot of companies wouldn't if they're not private equity owned, especially in the core middle market or the lower kind of end of the middle market. I saw this in a presentation a couple weeks ago, but broadly speaking, the U.S. middle market, which was defined by the Middle Market Center from 10 million of revenue to $1 billion in revenue, would be the third largest economy in the world. So it'd be U.S., China, U.S. middle market. Okay. So I think that shows how powerful, broadly speaking, the middle market, where most of what private equity is doing, and myself in private debt, are playing. The other interesting thing there is when you think about the private markets, so much of that has moved to the private markets and out of the banks. The data I've always heard presented was that you had kind of 15,000 banks down to 5,000. And that is correct. The interesting part of that, if you look at it, where it's been most dramatic, and this probably makes sense if you spend time, if you walk around your community, is the smaller end. In 1984, there were almost 11,000 banks with under 100 million of assets. In 2022, there were 666.
Wow.
So more than a tenfold, I guess, decrease or 90% decrease. And that's why private credit, private markets, private equity, all that has really grown. I think that the nice thing is today you have the expertise and the people to go look and figure it out. Like we've been spending time with all of our portfolio companies, as is everyone else, as is every sponsor, as is every lender, asking them what goods are subject to tariffs and what's that impact. The positive is they have the data, they have the people to analyze it if they need with support of the private equity firm to really be precise of say, this item comes from China, this one doesn't. The hard thing is you don't know the second order impacts, you don't know all these other impacts, but you can go look, okay, the glass for this product came from China. Its tariff is X, Y, and Z. What does that mean? I think the one thing it has shown to me, which doesn't minimize the impact of the tariffs by any means, but the actual cost of the item coming from overseas is typically so small that I'm not saying it won't cause. I have no idea what it's going to cause, but for most things, it's not like a doubling of the price of the overall component.
Along these lines, but just before we hopped on this recording, I was reading an article, I think in the New York Times, about Apple and how, they, as a gigantic company and a significant part of the stock market and all of these things, are facing the existential issue because the price of their biggest product, an iPhone, could triple. And they cannot repatriate for 9 reasons. They can't repatriate manufacturing. It would take 10 years,
so much money, so much time,
$500 billion to do that, and it's all a manufacturer crisis for them. But for them, unlike what you just said, and this is what I'm trying to get at in these issues, is we can all read about Apple and understand it because we're consumers, and Apple's covered by the press, 5 days a week. But for a $300 million industrial distribution company or widget maker, because that's really the world of private equity,
Yeah, and I think the unfortunate answer is it depends so much. Like if you think about so much of the U.S. economy, especially in the middle market, is service-based. As of now, there's no tariff on services. And to be fair, most of these businesses are U.S.-based or U.S.-focused or U.S. primarily employment. So maybe they have an offshore if they're in IT or something like that. But for a lot of businesses, this really doesn't move the needle for a company that does IT services or HVAC installation. Yeah, okay, maybe potentially their equipment's more expensive, but I don't know that. Depends on where it's manufactured. And so I think that's what's really hard is you don't really, for most sense, have big consumer product companies. You don't have big distributors. You don't have big retailers in the middle market. As you get to the bigger end, maybe you do. Maybe there are some small niche retailers. But the companies, to your point, like the Apple, the things we hear about in the headlines, GM, etc. And let's go down the auto value chain too, right? Like most of the tier 1 auto suppliers, those aren't middle market. Those are large corporates that are public. So I'm sure there's kind of the next level down. And where they'll be impacted is by demand, not by tariffs. Is that GM, do they stop making that car that their product goes into because they get products from X, Y, and Z and it's just not profitable? And in some sense, that's the hard thing about the situation is you don't really know the second, third, fourth order,
the ripple effect,
the impacts. You just
Three
you can
cycles.
analyze what you know, but there's so many unknowns. And to be fair, maybe that is where private equity excels, is they can do all this analysis, they can come up with the contingencies, and then wait to decide what to do.
Now, what I've been thinking about is trying to correlating it to the last crisis, which was COVID, where the world froze for 3 months. But to your point, private equity and the companies they owned were better positioned to just sit it out and wait, let things shake out. And then in a weird way, look at it as an opportunity because they had advantages both strategically and financially and situationally that non-private equity owned companies in the same sectors did not have the advantage of. And to your point about backstopping cash flow and some other kind of factors, and that's been going through my head a little bit is in a maybe weird way, are private equity owned companies potentially a little bit more insulated?
Yeah, I think they're more insulated because they have capital if they need it, where some otherwise company may not. Because I don't know, you would expect at some point the banks get tighter, but once again, I don't know. Like this is where like you don't know. Like does it if this causes a recession, banks will get tighter. If this doesn't cause a recession, I don't know. Banks may not get tighter, right? That's where there are so many hypotheticals. But a private equity backed business has access to capital if they need it and if it generates a return. In addition, they have real benefits of expertise because they have private equity people and board members that may not be at the firm that may have been through a similar scenario before where someone else might not have that benefit of expertise. And they can share knowledge and best practices across the portfolio that they can say, this company is doing that. Well, why don't you consider that? And a company that doesn't have that network may not be as well positioned. I'm not sure it's 100% true, but it felt like the companies that reopened the quickest after COVID were the private equity backed businesses. Mm-hmm. The restaurants that immediately moved to delivery and outsourced seating, it felt like were the ones that kind of private equity or even like the big organizations that had the wherewithal, the knowledge, etc. So I think they should be well positioned and they should be able to do all the analysis and figure out what kind of scenario. I think the hard thing is every company is different. If you have a company that's like an Amazon aggregator and resell stuff on Amazon, that's a totally different world than, to my point, an HVAC business, a dental business. Another good example where we got a few inbounds is we have a couple car repair businesses. Your cars are going to keep needing to be repaired. If you need a new engine block and it's a BMW or a Toyota and that engine block's not made in the US, it's going to cost more. That is true, but you need a new engine or you need a new piece. I guess you could go buy a new car, but new cars prices are going to go up even more than the parts. And it doesn't mean they're not impacted. I'm not saying it's not the same magnitude of something kind of else.
I want to ask a couple of questions that are kind of a second level down. So, for example, you're on the credit side of the equation. Do you think that private credit will have more, the same, or less potential impact as sponsors?
I think potentially both. And the reason I say that is to the extent this causes a recession and to the extent it causes financial earnings to decline, which at minimum it should cause some companies' financial earnings to decline if tariffs continue. Maybe they can pass on all of it, but TBD on timing, etc. It tends not to be perfect. If it causes a recession, then a lot of companies' performance would decline. We do know in recessions, default rates and loss rates go up. So that would be a negative for private credit and a negative for private equity too, to be clear. It depends on how hard the recession is. The nice thing about being a lender is you need significant impairment before you're not getting your stated return. So if it's a small recession, maybe it doesn't move the needle, but no one knows. I think for a private equity firm, it's a little different. Now you've probably extended the time you have to hold the company, but I would doubt there's going to be many sales of companies in the next couple months. So you've extended the time you've had to hold the company, and maybe your earnings have gone down.
I mean, to your point about potentially impacting hold times, and it's going to have an impact on returns, at exit, things like that, because you're holding companies longer and other factors that, again, sponsors went through with COVID. It might delay a year or two of exits and this and that. But that's going to take, 3 to 6 months for that.
Yeah, I think what this really will do is show differentiation. I think you're already seeing on the company side have and have nots, meaning company is not impacted, company is. And I think you will see the same thing on private equity and private debt, both because of where they play, which that may not really reflect anything on them. That may just be luck of what was impacted. But then I think you'll also see which firms were prepared, which firms had contingency plans, which firms had the right staff. Like it's been a talk for a long time on the private credit side about building up workout teams. Today, that should be even more of a focus for anyone's questions as it was.
I want to pause for a second on the word workout and get to my favorite part of beer stories, which is beer. And I have selected today a Peroni, which would be imported. You can read into that what you will.
Did you FedEx a 12-pack to get it before tariffs?
No, we've had something from probably Costco in the downstairs fridge forever. I do love a Peroni, so it was sitting in the fridge, and I said, why not?
I have a Two Brothers Prairie Path, which is, I think, actually a local one. It's always randomly hard to find, even though it's local. Warrenville, Illinois.
Cheers, Nostrovia, all that good stuff. All right, my next interesting, provocative question. From none to some to a lot, do you think this will have an impact on fundraising?
Yes, unknown. Yes, unknown on how it impacts different strategies. I think it will definitely have an impact. I think it will slow down fundraising because it will cause a lot of inaction. People just say, I want to wait and see. The question I don't know an answer to yet, and you may not know for a long time, is does it show some strategies more resilient than others? Does it show that private credit, top of the capital structure, is really the best place to be? Does it show that private equity in some segment or some type of business or buy and build is the best? I don't know. I think it depends on how long. It depends on a lot of different things.
I mean, at the same time, a little bit of the counter pressure is capital providers are pressured to put the money to work. I understand that they may ride things out for a bit until things shake out because uncertainty is, the big boogeyman here. But there's a counter pressure to put the money to work.
Yeah, I think you could see people are tired of volatility in the public markets and now we want to be in the private markets. I think that is a logical extrapolation because if you're a retiree or getting close to retirement, instead of being 40% public equity and 60%, or I don't know what the right for that age of percentage, but maybe it's 40% in private markets that are paying you a quarterly distribution and don't have that volatility. So I think you could make a case for some things it could accelerate it. You could make a point for kind of private wealth, but I don't know. The biggest impact you would see would be if the market really falls a lot and stays down. Then you would have what's called the denominator effect, which is basically they get so overweight their private markets because private market values haven't fallen and the public markets have, that they basically are outside their allocation zones, meaning big pensions, big institutional investors, which happened the last recession, happened a little bit, I think in 16 as well, when the market had a little pullback. So I think you could see that depending on where the market kind of shakes out. That tends to be temporary, but it does cause issues. I do wonder what's the impact on international fundraising.
Our PE sponsor clients have been going to Europe the last year or two to fundraise, not just domestically. That's one of these big unknowns is, I'll call it, do you get painted with a broad brushstroke? Well, I'm just not going to deal with America right now. If, you're in France for a whole lot of political reasons, not just financial, I'm not saying it's going to happen, but it all of a sudden out of the blue, it's not just this firm from New York. It's, we're just going to not deal with
You're
the US.
correct. I think there's two. There's kind of one, it's too unpredictable. I don't want to put any money in the US right now. Or the longer term, do they just say, I'm sorry, we don't view you as a good country to invest in for XYZ reason? Because that seems a little hard to believe, but you never know.
Well,
You
I
never
mean,
know.
how much Canadian money out of the pension funds
Correct.
is invested in these firms right now? And given what's going on right now, that is not off the table at all to think for candidly strategic, patriotic, personal reasons that these folks may just
Correct.
consider leaving the market.
You're already seeing it with travel, right? There seems to be some conflicting data. Sometimes you read something and they say, no, travel coming to the US for foreigners is fine. And then you read something else and they say, no, it's not. But it would make sense to me that there will be less international tourists into the US this year than expected. And that will have an economic repercussion to our country as well. One of the interesting things I heard is, I guess there's basically a travel balance, is maybe the way to put it. So, like, there's an import export balance. There's, in essence, the same thing on travel. And it's similar to most of our import export that we Americans spend far more money overseas and outside the US than people traveling to the US. And I'll be interested, like, my expectation would be the US travel is down this year from what was expected coming in. I don't know. Like, are people going to say, I don't want to travel out? I think that goes into the question of consumer confidence and a lot of other questions. I'm not sure they're
Absolutely.
going to choose to do it because they think some country's going to be mean to them or angry at them because of all this. I think it really comes down to what is the state of the economy, and unfortunately we don't have that data yet.
A couple of years ago, I took my family to Australia, New Zealand. Well, our currency bought us a lot more
Mm-hmm.
power in those countries, and it
It's
shows that it
terrible.
does, and it has ripple effect.
Yeah, I think the hard thing today, and I don't know, maybe to wrap it up, is like no one knows what next week brings, and I think that's where it pays to be well capitalized and to have expertise internally and externally. And I think
What do you think the
to be
time
well
horizon
positioned.
is? Because stuff's happening every day, every 3 hours, that have the potential for a macro impact. What's the time horizon we should all be thinking about until some of this is going to reveal itself? Is it 3 months, 6 months, a year?
I think it's quicker. I think you'll get what first quarter GDP and basically all the March GDP stats somewhere here in the next couple weeks. I think I forget exactly when it comes out. What that won't tell you is April, but like it will tell you March. And if you read there's this Atlanta Fed Now or whatever projection that shows basically if you back out the extra imports that came in beginning of the year basically to get ahead of tariffs, it's like negative 10, 20, 30, something in that range basis points for the quarter. And with the biggest tick down kind of in March. So, like, that will tell you what happened in the first quarter. And I think with that, you can extrapolate probably what April will be. And I think to your question, the question is how long does it last? Does it continue into May, June, July? Does it get worse? I don't think this is something in a year you look back and you say, oh, we were in a recession then. I think not real time, unfortunately, but I think you kind of get clarity quicker than that. The real question is how deep and how long, and no one knows. That's the real, I guess, fear factor is if it's a couple quarters of down 20, 30 basis points, I'm not sure that moves a lot of things, right? Like if it becomes worse, that's different. What's funny is if inflation really starts ramping up, technically GDP growth would actually be fine. because inflation is part of GDP growth. It would keep you basically out of negative. Your real GDP might be negative, but it would keep you out of negative GDP growth by just, in essence, having strong inflation. But that seems to be the big fear, is really stagflation. And
Tell me again the definition of stagflation, which is low growth and high inflation.
It basically comes down to what the Fed should do, is basically the point. Is in stagflation, the Fed has to choose which of its two mandates it wants to go after. So the Fed's two mandates are keep inflation low and keep full employment. And if you're in stagflation, it means inflation is high and the economy is not growing very fast, not very strong, which means you're definitely not at full employment. And the Fed has to decide which is it going to attack. And Volcker famously attacked basically inflation and massively shot up rates. And that's the concern, is then the Fed couldn't use lower rates to grow the economy, couldn't use monetary policy to help the economy. Where the normal case would be you have declining GDP growth, maybe negative, inflation's coming down because basically people are spending less, which keeps inflation down. If people are spending less, people have less jobs, therefore people are also spending less, kind of brings down inflation. And that allows the Fed to really drop rates and kind of get the economy going. So that's kind of the concern. I don't know that anyone knows. If someone does, they'll make a lot of money in the stock market, or they will.
Well, and that certainly was a topic this week.
That was a topic this week.
But anyway. All right, sir. Thank you so much for hopping on. Really appreciate it. I think that your expertise and your perspectives were valuable and appreciated, at least from my end.
Yeah. Well, thank you, Scott.
From all of us at Monogram Group, thanks for tuning in to Beer Stories for Private Equity,
Episode 20.
Don't forget to hit the subscribe button and you'll be notified as we release new episodes. Please check out the show notes in the description from today's episode. Our email is podcast@monogramgroup.com. Feel free to email us with any comments or questions, and we'll try to answer them in our next episode.